Okay, thanks for joining today's webinar. We will be going through some of the aspects that you should consider when you're getting a mortgage for yourself. So let's start with a quick overview of what the agenda for today is, right? What are the detailed items that we're going to have sort of discuss? So we're going to discuss insured mortgages, conventional financing, the cost of borrowing, and that is where we sort of compare what insured mortgages cost versus what a conventional mortgage would cost you. We would go over some of the choices that are available to you in terms of the payment frequency that you can choose, the mortgage term, the amortization period, prepayment privileges, the fixed interest or variable rate interest, and I'll also explain what each of these terms mean in case you don't know already about them. We'll also cover something called as prepayment penalty, if that is applicable in your scenario. We'll also discuss introduce the concept of standard charge versus a collateral charge mortgage. And also we'll discuss some of the aspects which are not really covered when you're actually going out and getting a mortgage. Something like, what do you do when you're sort of gradually building your equity over time? What options are available to you? I'll also cover some of the special programs which might be applicable to you for your circumstances. And lastly, I'll also go over what my approach is when deciding or when in terms of helping you decide on what the right mortgage should be for yourself. So that's a brief of the agenda for today. Well, the goal for today's webinar is, of course, to get you the basic information about standard mortgage choices which are available in the market, and educate you enough so that you can ask the right questions and seek the required guidance when you're working with a mortgage broker or even maybe directly with the bank. So let's get started. I'll have a quick disclaimer, obviously, since this is a sort of general information that I'm sharing today. You do need to seek some professional advice based on your specific situation as you are going out to get your own mortgage or make changes to a mortgage that you might already have. Okay. I'll also give a brief introduction about myself. So my name is Neil Joseph. I am a licensed mortgage agent with the Windrose Group. My mission is to increase the knowledge of my current and prospective clients about the mortgage financing options available and help them make an educated choice. So with that background, let's get started with insured mortgages. So I hope you've heard about insured mortgages. Steve, I think you are pretty much aware of that.
Yeah.
Okay. So just to give a brief context about why the need for insured mortgage came into the picture, right? So when bank or lender is giving a borrower a loan, they're obviously taking a risk in terms of whether the borrower is going to return that money, meaning principal amount, and also are they going to give the interest, which is nothing but a charge for taking on that risk. Now this interest or the charge sort of varies depending on the level of risk involved in the lending operation, and that is pretty basic. That's the basic premise of the lending business. Okay. So suppose we have two borrowers who are applying for a mortgage. The first borrower is bringing maybe 5% down, and the second borrower is bringing probably 25% down payment. From a lender standpoint, which borrower do you think is more risky? Would you say it's the first one who is having 5% down, or maybe the second one who has got 25% down payment?
5%.
Yep, that's right. So the first borrower, because of course the skin in the game is lesser, and so the lender would typically want to charge a higher interest rate for borrower number one than they would do for borrower number two, and that is just good business sense. But what happens is when interest rates are high on a loan, the borrower is able to only get so much, right? The borrowing purchase, the power sort of reduces, And all of this can make home ownership difficult for borrowers with less means. Somebody who has a lower salary and this is not able to bring higher down payments to make a purchase. And as you know, housing is obviously a political issue, and so the government wants to do something for such borrowers. And that is where the concept of insuring the mortgages came into the picture. And this helps loosen up the lender's purse, because then there is an incentive for them to lend money to borrowers with less down payment. So as it stands today, insured mortgages are available for owner-occupied properties and rental properties with 2 to 4 units. And the minimum down payment requirement is 5% in most scenarios. Now, suppose you do have a mortgage wherein you are probably putting 30% down as well. So you can in fact go in and get an insured mortgage if you wish to pay so. You obviously get the benefit of the lower interest rate, but it is not a requirement as far as regulators are considered. From a regulation standpoint, the requirement is if you have over 20% down payment, then you need not have an insured mortgage. And as I said, the cost of this insurance is the insurance premium which the borrower sort of bears. So any questions about the insured mortgage that I sort of went over? And then so conventional mortgages are those mortgages that do not require an insurance. So the lender who is giving a conventional mortgage is exposed to the risk of loss if the borrower doesn't pay the lender back. So that means that the interest rates that the lender charges tend to be a bit higher to compensate for the higher risk. Now, the lender has an ability to in fact get the insurance, the mortgage insured, but at their own cost. It is not something that the borrower pays for. So some of the benefits which come to the borrower because of a conventional mortgage are the borrower typically has up to 30 years to pay back the mortgage. And in fact, there is one lender out there who will give probably up to 35 years as a prepayment period or the amortization period. Secondly, the borrowers get a higher mortgage eligibility given that they have longer time to repay. Insured mortgages have a limitation of 25 years, while conventional can give you up to 30 or 35 years depending on which the lender is, and hence more eligibility in terms of getting a higher mortgage. The third aspect is obviously the borrower doesn't have to pay the mortgage insurance premium, which can be as high as 4% of the purchase price in case of an insured mortgage. Fourthly, it sort of improves the cash flow on a property if the buyer or the borrower is looking at it as an investment or a rental property, meaning their mortgage payments are lower, so they stand to get a benefit more in terms of in-hand money once they are paid for other expenses. So these are some of the benefits when it comes to a conventional mortgage. Do you have any questions before we sort of go and compare from a cost of borrowing perspective as to what the numbers look like? Okay.
No, I'm good.
Let's go to next slide, and this is, I promise you, this is the only slide which has some numbers or calculations. Hopefully you're able to see clearly. So what I have shown on top is the best rates when it comes to insured mortgages or conventional mortgages as available in the market as of this week. So 1.85% odd for an insured variable rate mortgage and 2.15 if you're looking at a conventional variable rate mortgage. And I've shown 4 options here. So option number 1 is insured with the 5% down. The column number 2 has insured, wherein you are putting in 19.99% down as down payment. And the other 2 are conventional mortgages, wherein you're putting 20% down. right? The difference, and I would say, is when it comes to the amortization period. For one, I have considered 25. Let me put my cursor here. So 25 for one of the conventional mortgages, and 30 years of repayment period for the second conventional mortgage. And we are looking at a scenario where we are probably looking to purchase a house at $500,000 or $500,000. So if you notice, the down payment increases from 25,000 on to 100,000 as you look at different scenarios. So 5% down is $25,000, 19.99 would require $99,950. And the second row sort of shows the insurance premium that is to be paid with the insured mortgage. So one is 19,000, the other is 11,000 odd. So essentially, this is the mortgage value that you start off with, right? 949 in case of an insured with 5% down, 494 in terms of a 5% down, 411, 400,000 and 400,000. And if you look further below, this row shows the spread in terms of what the mortgage payments would look like on a monthly basis. So you have 2,000, which is the highest with this choice, and it can go as low as 1,500 if you're able to get a conventional mortgage at 20% down for 30 years. Is this part clear?
Yeah, it looks good, Neil.
Okay. Now, what happens after 5 years, right? You have been paying so and so amounts for each month, and the end of the 5th year or the 5-year term, this is what you would have as in terms of outstanding balance. So 412, 343, 336, and 349. So obviously, the conventional mortgage with 25 years has the lowest outstanding balance, but of course you have paid more, right, in terms of down payment and things of that nature. But the real comparison is when we look at the effective rate that you are paying at the end of 5 years, and this is calculated based on how much do you put in terms of down payment and where you are or where your mortgage is in terms of outstanding balance at the end of 5th year. So if I consider those 2 points, then a borrower would actually be paying at a rate of 2.74%, even though the stated interest rate is 1.85%, right? And in the second scenario, it will be 2.47%, even if the stated interest rate is 1.85%. And the difference is on account of this insurance premium that you're paying. The insurance premium which you're paying here, right? That is causing the difference for the rate, the effective rate to jump from 1.85 to 2.74. And this is, of course, assuming that the rates are not changing over the course of the 5-year period. So that aspect is, you could say, is academic. Is this part clear?
Yep, looks good.
Yes.
Okay. And the next 2 rows are sort of showing you how much of a payment would you end up making over the course of the 25 years as far as the first 3 options are considered, and over 30 years as far as the last option is considered. So again, the lowest that you would end up paying is, in fact, if you go for the 19.99 down, because you get the benefit of the lower interest rate, and then you're paid off the lower premium that you're paid. So, but again, this got a big assumption that the rates are not changing over the period of 25 years. If everything remains same, then this is what you would end up with. So this is marginally cheaper when compared to a conventional rate at 2.14. But if you just go in with a 5% down, you are still paying, even at the end of 25 years, at a higher rate than you would do so for a conventional. So again, these comparisons or options are applicable only if somebody has the headroom to make 20% down, right? So that's the only scenario where that individual has to sort of compare as to what makes sense. And again, this changes as the spread between the insured mortgage and the conventional mortgage sort of changes. Right now, we're seeing a 30.3% sort of spread or difference. If this narrows, then obviously this changes. Does it make sense to sort of visualize how this plays out?
So, Neil, you know what? Your image is blocking the last rows in the corner there. So what is the total payment over life for the conventional mortgage at 30 years?
For 30 years, conventional mortgage will be 642. So that, in fact, happens to be the highest payment over 30 years. But the benefit that you get is, of course, a payment which is lower by about $500 each month, and you get 5 years more to pay it down.
Neil, can you get, I see that all these are monthly payments. If you were to opt into a bi-weekly or weekly, are they available to you at the 30-year, with a 30-year AM?
Yes. In fact, I'm going to go to that. So all these options, the payment frequency options are available irrespective of what amortization period you choose.
Okay, thank you.
Mm-hmm. Steve, any other questions on the conventional?
No, that's good.
Okay. I'm not sure why it is blocking. My image is blocking. Maybe if I just maybe switch off my video, it might be, probably will help. I'll stop my video.
Oh, that did it. I was trying to move that window and I wasn't able to.
Okay. But are you able to see now?
I can see the whole thing now. I don't
Oh.
see you. I see the, the screen.
You don't need to see me. You need to see the numbers, right?
No, I see the numbers. I'm good.
Okay. Yeah. So this is the point sort of I was wanting to highlight. If you have a choice in terms of how much you have, you want to sort of put as down payment, then you should consider the cost of borrowing when making a choice. Right? Again, as I work with my clients, I tend to show where applicable these choices. But of course, I don't show it to everybody because then buying a home itself is an emotional ride. Mortgages an opaque topic. I don't want to share or make decision making slower by sharing too much of numbers. But again, if you are interested, do ask your mortgage broker if you're working with somebody else, or you can ask me if you're working with me. So I think that's pretty much I had to cover in terms of insured versus conventional before we sort of jump into payment frequency. Okay. So these are the typical payment frequencies available. So you could pay monthly, bi-weekly, or a weekly. So these are sort of the regular payments. And then you have two other options which are called accelerated bi-weekly and accelerated weekly. So the difference is, as compared to sort of a weekly or a normal monthly, is that you end up paying 8% more in terms of payment when you're choosing any of the accelerated options. So just to take an example, suppose your monthly payment is $400. Okay, so you would actually, if you're paying bi-weekly, you would pay half of it, and weekly would be sort of 1/4 of it. In accelerated option, you would probably end up paying an accelerated weekly option. You would typically end up paying $108 a week, right? So that's 8% more. Now it has an effect when it comes to your amortization period, and I have a chart which sort of shows what sort of difference it makes in terms of total sort of interest saving that you have over the course of the duration of the mortgage, as well as the reduction when it comes to the total amortization period. But these are the standard choices which typically all lenders give. Now, some lenders might require you that your monthly payment needs to come on the first of the month, while some other lenders may not really have that sort of restriction. You could actually be making a monthly payment any day of the month. Any questions here? Okay. There is another related aspect, and it is applicable only when your first mortgage payment is yet to happen, and that is something called as the interest adjustment fee. And that is a fee that the lender would charge if there is a mismatch between when your mortgage closes to when the first payment period starts. So just to take an example, suppose your payment or your mortgage closes on today, which is 29th of July, and your mortgage payment is on a monthly basis, and the lender chooses only first of the month as the payment period, payment date, then the first payment is due on not on the 1st of August, but on the 1st of September. Because mortgage payments, if you're not aware, are collected at the end of the period. It's not due as a prepayment, right? So like you would have this, maybe your cell phone connection or mobile connection, you actually prepay. But in terms of, in case of a mortgage, you're actually, it's a post-paid or a post, it's paid at the end of the period. So your first payment is due on the 1st of September, but what happens to the period, say 29 July to 1st of August? And that is where they would charge something called as an interest adjustment fee. And depending on the size of the mortgage, it could be a sizable amount. So just keep a note as you work out your closing date and what your payment frequency is. I know for sure I had a shock when I went through my first mortgage, and it was something that I could have saved if my broker had told me. Okay. So moving on, let's discuss a bit about the mortgage term. Now, in terms of the choices available to you, you have an ability to choose any term which is as little as 6 months to as high as 10 years, right? Now, in case you're not aware, in Canada, the mortgages are not available. Mortgage term is not equal to the entire amortization period. So suppose you get a mortgage for 25 years, the lender, the contract with the lender is only for a shorter duration. It doesn't cover the entire 25 years. The typical periods that are used or terms which are used is 5 years, and there is a reason for why it is 5 years. So yeah, as I said, you have ranges available from 6 months to 10 years that you can choose, but that doesn't cover the entire amortization period. So in effect, you would renew your mortgage for a new term at the end of the first term, and you would do so until you have paid off your entire mortgage. Okay. Now, where it comes or becomes a restriction is when you're getting a new mortgage or making a purchase, your eligibility amount or the mortgage eligibility is determined based on the interest rate which is available. Now, and for some reason or the other, the interest rate happens to be the most efficient when you're looking at a 5-year term. And that is the reason 5-year term is the most common, because it gives you the maximum purchasing power. But once you're through with the first term, you can decide, and you should decide, as to what is the term that makes sense to you, because you may not want to have the house or in your name, or you probably want to sell it off before the end of the next 5-year term or the next 3-year term, because that's a period that you have to sort of decide. Typically, we have seen is that mortgages do not last beyond 26 to 33 years, 33 months on an average. So typically people sort of break a mortgage term somewhere around the 2.5 to 3-year mark. Does that sort of explain what the mortgage term is? Is it clear?
Hey Neil, it's Steve.
Mm-hmm.
So I get the amortization is a calculation, and the term is actually when you need to renew. So when you talked about a 30-year mortgage, you're talking not the amortization, but the actual when the mortgage expires, right? Or it has to be renewed, or
Yeah, the 30-year reference was actually the mortgage amortization period itself. It's one and the same.
so the other question I have is why is it that in Canada it seems like it's mostly 5-year, and in the States it seems like people just go out for a longer term.
I guess it's got to do with how lenders have been able to maybe get that, because it sort of protects their interest, right? They are not committing to a longer term, and so they are sort of protected from a interest rate standpoint. They are not committing to a long period, which may go against their interest. So I think it is all about market dynamics and what they have been able to negotiate with the regulator. That's my feeling of it.
Thanks.
Okay. Now moving on, the amortization period, as we sort of discussed earlier, is the total period or the period of time that you require to pay off the mortgage. As mentioned before, the insured mortgages are capped at 25 years. So none of the insurers would allow a term beyond 25 years. While if you look at conventional, most often the insurers would allow 25-year term or amortization period. And as I said, there is one lender who would give up to 35 years. And this chart over here on the left sort of shows different aspects, right? So the bar that you see in yellow is the payment that you would make every payment period, right? And it is comprising of your interest payment and the principal payment. So in your first payment, you're actually pretty much paying only your interest cost. The amount which is going towards the principal is very, very low. But as you progress through your amortization period, the sort of proportion increases, with the principal becoming the larger component of the payment and the interest cost decreasing. That is why this yellow-green combination is shown.
So Neil, I have a question. So if we're asked to renew every 5 years, it seems like we're always going to be paying more interest than we are principal.
Well, if your outstanding balance is not changing, then you are actually picking it off somewhere in the middle over here, right? It's not reset to every time for your interest or interest component to be larger.
Hmm.
It's just that you're maybe changing lenders or maybe renewing the same lender, but it doesn't set you back unless you go ahead and change either the repayment period, meaning you extend it back to say 25 years for an insured mortgage,
Okay, I got you.
or to a 30-year for a conventional, right? So you keep it.
If you do 5 years, then you have to pull back the amortization from 25 to 20 years then, right?
Yes.
Okay, I got you.
Till that time, that aspect is not changing, you still get the benefit of this. And again, if you're working with a mortgage agent, you should also be able to continue to get insured rates if the purchase was made under an insured mortgage, right? So I think we were discussing a few days back. So I just wanted to sort of call it out for the benefit of Diana as well, that for insured mortgages, as long as the new lender, if you're shifting lenders, knows about the insurance, then he would give you the benefit of lowered insured rates, because you already paid the premium when you made a purchase. Okay. Okay. If there are no questions, I'll move along to the next, which is prepayment privileges. Now, as a standard, most lenders nowadays are offering a couple of prepayment privileges. Now, these could be like 15 to 20% of your outstanding balance. You could prepay within each mortgage anniversary. So suppose you're maybe say you're closing on a mortgage today. So between today and 1 year from now, you could actually prepay maybe 15 to 20% of your outstanding balance without having to pay a penalty on it. So that's the limit that is set. You could also make increased payments. So when you sign up for a mortgage, you probably you're given a monthly or a weekly or bi-weekly payment amount, but you have an option to make more payments. And when you make more payments, the additional payment is actually entirely going towards your principal. So there is no interest cost associated with that. So whatever you pay extra goes towards reducing your principal outstanding amount, which has a great impact on the end total interest as well as the amortization period. Now, I did some calculations. I ran a scenario wherein suppose you have a 500,000 mortgage when you start off with, and I worked out four scenarios in fact. One, if you do not make any changes in your payment, then you probably take around, I think, 1,289 or 99 weeks to pay off that mortgage. So this basically is your entire term. While if you're making accelerated payments, weekly payments, then you reduce off close to, I think, 120 weeks of your mortgage. And if you make incremental payments, meaning if you make, say, 15% more payment each payment period, then you're actually reducing it by more than 200 weeks. And if you do both, wherein you're doing an accelerated payment, which means you're making 8% more payments anyway because of the frequency at which you're making that payment, and you also increase your payment by 15%, then you're reducing it significantly. So you could keep closing as low as 950 or 55 weeks. Now, I know from personal experience, when I signed up a mortgage, I had a 25-year amortization period. What I did right away was I changed to accelerated payments. I increased my payment amount by 15%, and I did 2 bulk payments as well, which in my first year of my mortgage brought down the amortization period from 25 years to 16 years. So if you are able to do that kind of additional payments in the first few years of your mortgage, it has a very substantial impact on what your mortgage amortization period could look like, and by effect, what your ultimate interest payments could look like. And again, this is something that I would suggest if you're doing so against your principal property. If you have a rental property, then I would not suggest this, no, because it doesn't make sense from a cash flow standpoint. Is this helpful? Do you have any questions?
That's good.
Okay. Thank you.
Actually, I do have a question. If you purchase a home with, say, a basement apartment, you said it doesn't make sense if you've got if it's a rental property, but if you're purchasing a home for personal and you have an apartment, a basement apartment, can you apply those? Is that a good?
Yes, yeah, my scenario is exactly the same, and I do prepay in that scenario because I do not get the benefit of a rental property when I have a principal sort of resident, right? Because
when you're residing, yeah.
Yeah, because I don't get to claim the interest that I pay against my taxes. It's all because you get the benefit.
It's personal, yeah.
Yes, it's personal property, right? So
okay.
The benefit that you get is when you sell and you don't have to pay the capital gain.
Yes, yes, okay.
Yeah, so that's the reason, yeah, the strategy is sort of different depending on what use that property has.
All right, so as long as it's a principal residence, it's a good idea.
That's right.
Okay, thank you.
Yeah, Neil, I've got a question. So let's say, for example, you finished your 5-year and you're going to go to a new bank or a new lender.
Mhm.
You're not restricted with that, how much you could, lump sum payment you could put down, right?
Yeah. So when you are at the end of the term and
Mhm.
you're between changing lenders, yeah, you could prepay as much as you want because you're not tied by a contract at that point.
Okay. So what that means is, if I stay with the same lender and the 5-year mortgage is up, that part about your lump sum and how much you could do stays even after the 5-year mortgage, right?
Yes, when you get to do a new contract, the same restrictions come into play. But
Is that
even with the
negotiable?
same lender, you could do that arrangement of making a prepayment because in between contracts,
Mhm.
you can still do it.
Okay, because that's what I thought. I thought the whole contract is changed. I didn't think that stipulation would carry forward if your 5-year mortgage contract is over, right?
Yeah, but at the end of the 5-year contract, you're entering into a new 5-year contract.
And you can negotiate how much you're going to put down, even above what the old contract said.
Well, once you're in the contract, then your limitations are again 15%, 20%, right?
Mhm.
But in that very one day between on which that switch happens from the new old contract to the new contract, right?
Okay.
Before you move into the new contract, you say, okay, no, I'm going to prepay. I'm going to reduce my outstanding balance by so and so amount. And
Mhm.
this is what you need to consider for the new contract.
Okay. Thanks.
So it's a timing issue. As long as that is managed appropriately, you won't have a charge. Okay. So that's prepayment privileges. And I think that's a good segue into one other topic, which is fixed versus variable interest rate. So now fixed rate, as you all know, is fixed for the term of the mortgage. So if you have a 5-year fixed, then the rate doesn't change for you over the period of the 5-year contract, irrespective of what happens to the market interest rates. But if you are in a variable interest rate, then you are impacted by changes in the market interest rate or whenever Bank of Canada makes an adjustment to their policy rates. And again, depending on the lender and what they offer, the flavor of the variable interest rate product could be different. Most lenders in Canada offer something called as adjustable rate mortgage, wherein the payment that you make on a periodic basis, be it monthly, bi-weekly, weekly, would change based on how the interest rates are moving. That means you would have a sort of a predetermined principal component of the payment, but the variable portion of the payment changes based on how the interest rates are moving in the market. So if they are reducing, your payment reduces. If they are increasing, your payment increases. So that is where the payment fluctuates when you have an adjustable rate mortgage. Then you have something called as a variable rate mortgage or variable interest rate mortgage. It's either called VRM or VIRM. Here, your periodic payment that you make does not change even when the interest rate changes. But what happens is your principal amount would change based on how much room is available for making that interest payment. So interest payment takes priority. And if there is no room, it would start eating into how much of principal, how much of payment is going towards you, reducing your outstanding principal. Right? So that could mean that if interest rates are higher, and since you're not sort of paying back the principal amount, it could mean that your amortization period could in fact increase because what was assumed earlier is not valid anymore. That's the risk with VRM product. And again, with all variable rate mortgages, you have an option to switch from a variable to a fixed interest rate product whenever you feel there is a need, or if you feel that, okay, I am not going to get the variable rate benefits anymore because the rates are going to increase, then you have an option to switch to a corresponding fixed term with the same lender, and they usually match up to whatever is the remaining period on your mortgage.
Does every lender offer that switch, Neil?
Yes, to my knowledge, every lender offers the facility to switch from a variable to a fixed.
Okay.
Not the other way around, only variable to fixed.
Right. Okay. And the variable rates tend to be lower.
Yes, so that is.
And if you switch to fixed, it's going to be slightly higher.
Yes, that is where I've showed this chart of how the variable and the fixed rates have sort of trended over the years. This is discounted rates which are available to the market or to borrowers. And the data that I could get was from somewhere around 2005 onwards. So there have been only maybe very, very short periods where the variable rate interest has been over fixed rates. This is only one period which is significant. And there was probably some bit, if you look closely, between 2006 and 2010. So they tend to play, they tend to have that sort of spread. Right now it is very, very less. It's as short, as small as 0.06% difference between the best variable rate and the best fixed rate. If you are talking about rental property, then what I advise my clients is to go with a variable rate product. And I'll explain what the reason is when we talk about the next topic.
Okay.
Any questions here? Okay. If not, we'll go to the thunderbolt of this presentation, which is your prepayment penalty. Now, prepayment penalties apply when you are trying to make a payment which is greater than what is allowed from a limit perspective. Right? So earlier we discussed about the ability to make 15 to 20% prepayments or prepayment in a certain annual or mortgage within a mortgage anniversary period. If you are to make a payment which is higher than that, then a payment penalty applies. It also applies when you want to close off that mortgage for any reason. The reasons could be, yeah, I want to sell my house, so I don't need that mortgage anymore, so I'm going to close that mortgage, right? So that triggers a prepayment of that mortgage. Others could be, no, I want to refinance my mortgage because today I'm paying a very, very high fixed interest rate. The interest rates have reduced so much and I want to switch to a lower rate. And in that scenario, you would again have to pay something called as the prepayment charges. And it sort of differs based on whether you are in a fixed rate mortgage or a variable rate mortgage. The difference is, if you are in a variable rate mortgage, your penalty is limited to 3 months of interest. So if it means that in your last payment, you had probably $500 going towards your interest payment, then the charge to break out of your mortgage could be as low as 500 into 3, which is 1,500, and you can get rid of your mortgage, plus some administrative charges that they would have. So that is all you are going to pay. But if you have a fixed rate mortgage, the calculation is the higher of the 3-month interest or something called as an interest rate differential. Now, the interest rate differential calculation is a bit complicated, wherein the lender looks at what is it that your current interest rate is, what is it that they're offering to customers for a period that is remaining on your mortgage, and they do some weird calculations to arrive at a figure. And they would charge you the higher of these two figures. And typically for fixed rate mortgages, it tends to be the interest rate differential tends to be a higher amount. And that is where you get penalized for choosing a fixed rate interest product. There is also difference in terms of how the big banks, so the big six banks within Canada, calculate this interest rate differential versus how some of the other lenders who are mortgage lenders, but their only business is mortgages, calculate this. They tend to be a bit more lenient in terms of how they calculate penalty, and the difference could be stark. If you're looking at borrowers who are signed up with the big banks or the monoline lenders at the same time, and they want to break out of a fixed rate product. And again, mind you, as the rate decreases, the penalty only increases, because that's how the banks compensate for their loss of interest that they are losing out on you breaking out of a mortgage. Any questions?
Is there a significant difference between the big bank and the mortgage brokers? The difference?
Yeah. So the big banks versus the monoline lenders, that's the term that we use. Yes, it can be significant. For big banks, it could be as high as maybe 2 to 3% of your outstanding balance.
I'm sorry, it could be as big as what?
2 to 3% of your outstanding balance.
And the monoline lenders?
Monoline lenders are much lower. It's probably a fraction of it, maybe 25 to 30% of what they are.
Okay. And the penalty, is that spread out again? Is it put back into your mortgage, or is that a lump sum you have to pay when you're when you break a mortgage?
That's a very good question. So most lenders, what they would do is they would allow you to capitalize it, meaning they would be willing to absorb at least a part of that penalty into the new mortgage.
Into your new payments, okay.
That's right.
Yeah, okay. A part of it. So
yeah,
you may have to.
Yeah, it depends on how big it is. But
okay.
yeah, usually they do absorb at least a part of it.
Okay.
And if you are switching for some reason, and if you're wanting to maybe switch only for the reason of lowering your fixed rate, then that's a calculation that I or any other broker can help you determine in terms of, okay, what is the saving that you have by moving to a new mortgage rate versus comparing what you would pay if you just remain in your current mortgage, and also the penalty which is applicable, right? So there has to be a positive difference when you're making that shift, and we can help you. I or anybody else that you engage can help you make that determination.
Help determine whether it's how much of it, whether it's to your benefit and how much it would be to your benefit.
That's
right. Okay, thank you.
And I just want to be very, very clear. I don't have a sort of a bias towards big bank or a monoline lender as far as my compensation is considered. I get paid pretty much the same irrespective of the lenders. I'm telling so just because it's my interest to keep your interest safe. Right?
Thank you.
And that's the reason I'm sort of highlighting this difference when it comes to penalty.
Yeah, thank you.
Yeah, so I think we have sort of discussed with a lot of the choices which are available generally when it comes to a mortgage. We talked about things that you should consider when you're getting into a mortgage, the adjustments that you can make over the course of the mortgage in terms of how you can change your payment frequencies and the prepayment privileges that you have. And we also sort of discussed about how what sort of charge might be applicable if you have to sort of break out of a mortgage during the term. Now let's maybe spend a few minutes on this one topic, which is again a difference between how big banks operate versus how the monoline lenders typically operate. So there is a thing called as standard charge or a collateral or two concepts. There is a standard charge mortgage, and there is something else called as a collateral charge mortgage. It is just the difference is just how the mortgage is registered against your title, right? So different banks operate differently. Some of the bigger banks only offer something which is called as a collateral charge mortgage. And the way it operates is it sort of protects the lender from all the current and future equity in your property. And they sort of allow you to, they prevent you from allowing you to add something called as secondary financing. So it could be a second mortgage that you could get from a different lender. So they are sort of putting a stranglehold on what you could do on top of the first mortgage that they hold with a certain bank. Again, the difference is, unlike your standard charge mortgage, a collateral charge is re-advanceable, meaning once you are qualified with a bank and you have a sort of a limit established with that bank, and just to take an example, let's say you bought a property for $800,000, and if the bank is giving you a collateral charge or putting a collateral charge, then they would probably be offering you an ability to borrow up to the same 800,000, even though your mortgage is lower, typically would be lower by at least 5%, but they would allow you to borrow up to 800,000 and on a repeated basis, meaning if you pay down your mortgage to 600,000, you would still be able to go back and ask for 200,000 more without having to requalify. So that's one advantage if you're looking at collateral charge mortgage. But the only option is, but the drawback is, of course, that you're limited to that lender, right? You cannot shop around and get that benefit or get the most cost effective maybe option, because there is no room for you to get that covered off because they are claiming 100% equity in your property. Does it make sense?
Yes.
Collateral charge mortgage can also be a bit detrimental when it comes to switching at the end of the term, because the way the instrument is sort of defined, you have to engage a lawyer and need to spend money on that to get it switched from one lender to another. So obviously your cost to switch is higher. And that is what one of the things which lenders have in mind, okay, saying that if you are with them and the cost is too much, then you would probably not even go venture out and renew your mortgage somewhere else, right? And the other is, of course, if you have, for some reason or the other, to switch, then that means you have to unwind all other instruments that you have. So if you have a first mortgage, you have a second mortgage, and maybe a HELOC, then you have to get rid of everything else before you're able to move your first mortgage, right? Of course, there are advantages, as I said, that you get benefit of multi-part product, you don't have to requalify, this and that. So you have to balance out and see what makes sense to you. What is it that you're willing to adjust and what you're willing to take on as a risk, and what is a strict no-no to you. Because the way collateral charge mortgage works is, even if you have a credit card with the same lender and you default on that, then they can come after your property for that default. Okay. So that's the key difference that you should understand. So some of the banks do not offer a standard charge mortgage, so they only offer the collateral charge mortgage. So ask your mortgage broker as to what is it that the lender that is being offered to you operates.
What about line of credits, Neil? You hear about, people that have a mortgage and they have a line of credit.
Mm-hmm.
I think it's secured by I guess the house would be collateral.
Yes, so you could have a unsecured line of credit. You could have a home equity line of credit. So home equity line of credit is secured by the property that you have, and the benefit that you get by securing against the property is that you're charged a lower interest rate.
Right. Okay.
Right. But yes, so now
if you did the collateral charge mortgage with a bank,
mm-hmm.
you would likely be able to get a line of credit once you have some equity in the home. Well, you would if you're putting down 20%, but
so you can get a collateral charge mortgage even if you have a 5% down, but you would be able to make use of that only when your equity is more than 20%. Right? Till that point, you
Okay.
would
Oh,
not
so you
want
have the equity, right?
Yeah.
So do mortgage brokers offer lines of credit?
It depends on the lender. Not all
Okay.
lender offer that through the broker channel.
Okay.
Yeah, and again, just to address that point about secure line of credit and unsecured line of credit, it's up to the borrower to ask for a line of a home equity line of credit, even if they have a collateral charge mortgage, because I have seen clients who in effect have their entire property with the lender because they have given 100% of their charge as collateral, but they were still offered a secured line of were offered an unsecured line of credit. They were being charged a higher interest rate, even though technically it is all secured, right?
Okay. Okay.
Yeah. So it's up to the borrower to be vigilant about how the lender is offering.
Right. Okay. Thank you.
Yeah, I think we are a bit running over a bit time, so let me try and close the next two topics, unless you are able to stay along for maybe 10 more minutes. Again, this is access to equity is one topic which is probably not discussed when you're getting into a mortgage, but I just want to cover that as well. And we probably discussed a bit in the previous topic as well. So as you said, as I said, you can get something called as multi-part mortgage, wherein it's not just mortgage but a HELOC also packaged into it. And this is usually available with a collateral charge mortgage. There are very good products available from Scotiabank and Manulife if you want to make use of this. It just gives you an ability to, again, with a specified option to be able to re-advance whatever you qualified for once multiple times, right? So that's available to you. You could also get a home equity line of credit if you have more than 20% equity. Similarly, second mortgages with some lenders if you have more than 20% equity. And also, one way to get access to your equity is to refinance your entire mortgage. That means you are breaking your mortgage and signing up for a new mortgage for the entire amount, but maybe at different rates and different terms. So now these are some of the ways in which you can get access to the equity that you are building as you are making payments, drawing down the outstanding balance, as well as the value of your property increases over time. Okay. So in case you are thinking of wanting to take some equity out down the line, make sure that you are going in with a plan as to how do you want to access that, right? So are you looking at refinancing, because refinancing gives you the cheapest option or the cheapest borrowing cost when compared to the others, because second mortgage is costlier, home equity line is costlier, multi-part mortgage, depending on how it is set up, could also be more may not be cost efficient. So refinance obviously is the most cost efficient, but it means that you have to break the mortgage. So you have to balance out that. And the equity that you pull out of your house could be used for any purpose, right? You could be paying for another property. It might be to consolidate your debt, be it credit card debt, car loan that you want to get rid of, or you want to just maybe spend it on travel or education, medical expenses, basically anything that you want. Okay. Quickly move on to some of the other programs which are available if you're out and out to get a mortgage. You could get something called as a cashback mortgage, wherein the lender would give you some money back when you close on the mortgage. You can always have an open mortgage and not have the headache of prepayment penalty, but it comes at a higher interest cost. There is a unique product in the market which gives you 3 months of interest-free mortgage. Flex down mortgage is where you are borrowing a part of the down payment. New to Canada is when you have for immigrants who are new to Canada, and it's the benefit that they get for the first 5 years of their stay here, and so on and so forth. So there are various special programs available depending on your circumstances, whether you have income or whether you have a business income, whether you want to purchase and improve your property, you want to buy a cottage, you want to buy a raw land. So depending on your specific needs, there are special mortgages available. And again, not from every lender, But yeah, so depending on your requirement, I'm able to access different lenders to satisfy that need. And this is pretty much the approach that I follow to address, to make sure that you are getting the right mortgage. So basically, my first step is to understand your preferences, gather some documents from you in terms of supporting your income and credit history and things of that sort, and present back some options to you so that you can compare and tell me as to what is it that you would like to proceed. And so once you have finalized the option, I would go ahead and secure a commitment from the lender. Obviously, the preference is to make sure that it is, or preference is to go to an A lender and secure a long-term solution. But if there are hiccups, then we do have access to B lenders and private mortgages. But again, the goal going in is that we know how we will get out of that situation and be able to place you back at A lender. So that is always the going plan. If that is not feasible, my recommendation to the borrowers is you should look for other options. There are some other options available like rent to owns that we can investigate rather than tying yourself into a mortgage which can end up bad for you. Now, of course, I'll help you close the mortgage, look at any corrective actions that you want to if you are not able to get into a mortgage, and also periodic reviews after you get into a mortgage. So this is pretty much how I offer and operate. Sorry for the rush. I think we're over time. I just want to make sure that we're covering everything. Any questions?
Does a self-employed person always go to a B lender initially?
No.
Not always?
There are insured products available. The only requirement comes into is that a self-employed needs to show 2 years of sort of track record. So 2 years of tax statements is generally sufficient to establish the income requirement, sort of establish what the income levels are. And as well as that, once that is proven, the rates are same as any other standard borrower.
Okay, thank you.
But in case the income comes lower, then we have something called as stated income approaches, wherein it's still with the A lender, but you need to pay for an insurance even for down payments more than 20%.
I'm sorry, you need to pay what?
Mortgage insurance.
Oh, okay. That's if you're less than 20%.
In
Down.
case of self-employed, which is going with a stated income, and when I say stated income,
Okay.
the income that you pull, it's not defined by what is in your T4s or your tax records. It is a number usually between what your business makes and what you claim as you make, right? Because self-employed people have a lot of room to play in terms of claiming expenses back, trying to keep their taxes low. So
Okay.
stated income is a facility which is available to all lenders mostly, wherein you can choose what your, or not you can choose, but you can reasonably state what your income is, and they will buy, they may choose to buy it. And if they choose to buy that,
Okay.
that value, they would give you a mortgage, but they would just ask you to pay insurance on that. Again, we can go into detail as to how that operates if you have the time. Any other questions?
I think my internet went in and out there for, but can we get a copy of the slides, Neil?
Yeah, surely. I will actually be publishing the entire recording itself.
Okay.
And I can send you a copy of the slides as well.
Thank you.
Yeah. So I think that was the end of my presentation. I'm sure there are obviously a lot of questions that you probably have. I can go over them right now with you, or we can schedule some other time for to go over that individually, or it suits you.
That was great. Thank you, Neil.
Thank you,
Yeah,
Steve.
thanks. I'm going to let this information gel, and if I have any more questions, I'll get back to you.
Sure.
Thank you.
I think I'll send across whatever I have. Again, a few other aspects that I just want to share with you over an email, and also the slides and the recording. Okay.
Perfect.
Thanks for joining.
Thank you.
Have a great evening. Sorry for the
You-
troubles with the internet in between.
No problem.
No problem. I think it might have been me too. Thanks, Neil. All right.
Have a good
Good
evening.
night.
Take care.